So another fundamental accounting standard that we need to understand in order for us to position ourselves to pass the corporate reporting or financial reporting examination is IAS 38, and that is intangible assets. The question we ask ourselves is, what are intangible assets? In a simple language, intangible assets are non-monetary assets without physical substance. Example of intangible assets can be development cost, goodwill, franchise, patent, copyright, trademark, brand name, customer list. All of these are intangible assets. But the question we need to ask ourselves is, what is the recognition criteria for intangible assets? The answer to that lies in the recognition criteria for all assets, right? So the same rule that we apply to IAS 16, IAS 40, it's the same thing here. So the recognition criteria is that it should meet the definition of an intangible asset, definitely. And then the cost can be reliably measured. And then it is probable that the economic benefit or service potential in the asset will flow to the entity. So that's the default issue that we need to understand. But the key question also then we need to get ourselves into is, okay, how do we measure intangible assets and how do we recognize intangible assets? To answer that question, it is important we understand that as per the standard, the initial cost of intangible assets shall be the purchases cost or the construction cost or the development cost plus all other directly attributable costs incurred in bringing the asset to its present use or ready for sale. And so that is the idea about the initial measurement. But one thing we must understand is that IAS 38 paid attention to a number of items that we have to be mindful of when it comes to how we account for them. That is research, development, and goodwill. Stay with me carefully. Research simply has to do with the investigation that an entity undertakes to gather information about an existing product or a potential product that the entity is seeking to bring into the market. And so the standard states that all research expenses must be written off in the profit or loss account as they are incurred. In other words, whatever expenses we incur on research must be expensed in the profit or loss account in the year that we paid for it or as and when we pay for it. But it is important you understand that capital expenditure incurred on research must be capitalized and depreciated over the economic useful life of the asset. So let me give you an example. Let's say that we employed 5 people. They should go around the country to undertake a research for us to see how tertiary institutions are using our platforms. That is, students of tertiary institutions are using our platforms. That's our YouTube channel, our Facebook, our Instagram, and most importantly, the Nhyira Premium mobile application. How are these students using the platform? So we employed 5 people. Then we give them money for their transportation. We give them money for their hotel expenses. Then we give them 5 iPads, so that because we have a software on the iPad that they will record the information that they are going to be gathering into, so we can use here at our HQ. So these 5 people, we're going to pay their transport. We give them money for their hotels. We give them money for any other thing that they want to buy to facilitate their research. And then we give them 5 iPads because we have a software on it that they are going to be using to gather the information. What IAS 38 is saying is that the things that we are paying them, like their allowances, the travel, the hotel that they're going to be lodging, the cost of all that, those are going to be written off. They are going to be expense. But the cost of the iPad cannot just be written off in 1 year. Why? Because the service potential or the economic useful life of the iPad doesn't end after the research. For that reason, the cost of the 5 iPads will be capitalized so that we will then depreciate it over the economic useful life of the iPad. If it is 3 years, then we will depreciate it over 3 years. That is the idea about research. The second thing that we need to be mindful of is development cost. Now, after research, the research data is going to be used to now develop a product prototype, then we do a test run and then take it to the market. And so development costs can only be capitalized after certain recognition criteria are met. What does that mean? It means that we can only capitalize development cost when, one, we can say it's a separately identifiable asset. Two, the cost can be reliably estimated. Three, there is a commercial value for the asset or the products being developed, meaning there's a ready market. Four, it is technically feasible, meaning that the entity can actually undertake this project. And then five, we can say that it is overall profitable. Now, it is important you understand that there could be a ready market for something, but may not be profitable. And so we need to know that, yes, there is a ready market, but it's also profitable. And then the last thing, which is the sixth thing, is that resources are available to complete the project. And so that is the idea about the recognition criteria for development cost. And so in the exam hall, this is what is going to be happening. Yes, you are going to see the cost. The development cost will ultimately be given. So we don't need a miracle on that. But there is an additional information that you have to always be on the lookout for. Either something will be mentioned about the commercial value, that is a ready market, or the technical feasibility that the entity can actually do it. They have all of the things that they require, the expertise to do it. And then resources are available to carry it to completion, meaning the funding, the expertise, and everything are available. One of these three items will be in the question to add to the cost of development that has been given in the question. Then we can say, let's capitalize development cost. So if the recognition criteria are not met, then the development cost will be written off in the P&L account. What does that mean? It means that if in a question we are reading and we have been given the development cost to be, say, $10,000, but as at the reporting date, the entity is unable to determine whether it is commercially viable or whether it is technically feasible or whether the entity can actually get the necessary resources to complete it, then in that case, we would have to write off the development cost for the year. Why? Because although the cost has been determined, it's not commercially viable, it's not technically feasible, and there are no resources available to carry it to completion. That is the idea about capitalization of development cost. So when the criteria are met, we capitalize it. If we don't see those three extra items, it is written off in the P&L accounts. But it is important you understand that sometimes the recognition criteria are met, so the entity has capitalized the development cost. Now, what is going to happen sometimes is that management may decide to revalue the development cost. But it is important you understand that development cost cannot be revalued. What the entity can do is, if the product is still in the development stage, then what they can do is to test for impairment. It cannot be remeasured upward. So for instance, an entity says, oh, we spent $2 million on the development and it meets the criteria. Then at the reporting date, the directors say, hey, if we look at this product, the way it is going, the way the market is growing, we feel the value of the development now is $5 million. So the fair value of the development is $5 million. No, it's not $5 million. The historical cost, $2 million, is what we are still going to be using. So we test for impairment for development cost, but they cannot be remeasured upward. That is the idea about development cost. Then the last thing is goodwill. Now, IAS 38 simply states that an entity can only recognize goodwill arising from acquisitions or business combination. What does that mean? If we want to buy a company, so we have Ohima Limited going to buy Adepa Limited. So Adepa Limited's net assets or fair value of their net assets at the date of the acquisition is, say, 5 million. But they are requesting for 7 million. So Ohima Limited pays 7 million for the business. Okay, so their net asset is 5, but we paid 7 million. The extra 2 becomes goodwill. IAS 38 states that, yes, goodwill can be recognized from business combination. Now, for consolidation purposes, where we are paying less than the net assets of the entity, then that is gain on acquisition, and that must be recognized in the P&L account. That's a consolidation issue. We'll talk about that later on when we get into consolidation as we continue with this particular discussion. But we can only recognize goodwill arising from business combination. Okay, so what if in the same scenario, Ohima Limited says, oh, we've employed a valuer and the valuer has looked at our net assets and we feel that the fair value of our business is $12 million. The fair value of our business is $12 million, but our net asset is $10 million. So we too, our goodwill is $2 million. No. Internally generated goodwill cannot be recognized in the financial statement. It is important you understand this. There's a difference between internally generated intangible assets and internally generated goodwill. So there are sometimes you may read a question and they will say, oh, an entity developed a brand and it meets the recognition criteria for capitalizing internally generated assets on this day. Brand is an asset. That one we can recognize it. But internally generated goodwill cannot be recognized in the financial statement. And so this is the guiding principle for how we recognize research expenses, development cost, and goodwill. Then the final thing we then have to ask ourselves is, okay, what is the subsequent measurement for intangible assets? It's pretty simple. The standard states that the subsequent measurement of intangible assets depends on whether the assets have finite or definite economic useful life or infinite or indefinite economic useful life. What does that mean? It simply means that intangible assets with a definite economic useful life, we amortize the cost over the economic useful life of the asset so that the carrying amount of the intangible asset at the reporting date will become the historical cost less the amortization and any impairment, because we may have to test for impairment as well, and if it suffers an impairment, we'll write it off. But intangible assets with indefinite economic useful life, that one, you can't amortize it. So what happens is that at least once a year, the entity will test for impairment. And where the intangible assets have suffered an impairment, and where the intangible asset has suffered an impairment, then that impairment will be written off in the P&L account. So the journal entry for that will be to debit profit or loss account as an expenses and credit the intangible asset. So that is the idea about the subsequent measurement of intangible assets. And so if we bought a franchise, and the franchise is for 10 years, then the cost we incurred will be amortized over 10 years. Or we have a brand name, or we have a trademark, and we have determined that, okay, this trademark is going to last for 20 years. Then we're going to be amortizing it over 20 years. Or we bought a copyright, and that is giving us the right to produce a certain product or do something for 5 years. Then we're going to be amortizing that cost we've incurred over 5 years. Why? Because these are intangible assets with definite economic useful life. But if we are dealing with things that do not have definite economic useful life, like goodwill, then we test for impairment, and in that case, there is nothing to be amortized. So basically, when it comes to intangible assets, IAS 38, these are the things that you need to understand. Let me hear from you in the comment section any other accounting standards that you want me to share my thought on, and I'll be covering it in the next episode as we continue with this IFRS masterclass. Remember to share the video, subscribe, like, and follow, and I'll see you in the next one.